Now, when a company wants to know whether their assets have suffered an impairment loss or not, for a company to know whether their assets have suffered any impairment loss or not, that company will have to compare the carrying amount of each asset, whichever the asset they are testing. They compare the carrying amount of that asset with an amount we call the recoverable amount, with an amount we normally call recoverable amount. So they have to compare with an amount we call recoverable amount. Now listen, an asset is said to have suffered an impairment loss if the carrying amount of the asset is higher than its recoverable amount. To know whether an asset has suffered an impairment loss or not, you compare the carrying amount of that asset with its recoverable amount. Normally, the carrying amount of an asset is the value at which the asset appears in the books. The value at which your asset appears in the books, meaning initially the net book value of the asset. That net book value is what we refer to as the carrying amount. Let's assume that in your company, one asset had a carrying amount of 1 million shillings. Then you calculated its recoverable amount. You calculated its recoverable amount and you found it was 800,000. We shall talk about how to compute the recoverable amount. But let me assume as a company you have computed the recoverable amount of this asset and you have found it is 800,000. So we want to know, has this asset suffered an impairment loss or not? I have said an asset is said to have suffered an impairment loss if the carrying amount of the asset is higher than its recoverable amount. So now that the carrying amount is higher than the recoverable, then we say that this asset has suffered an impairment loss of how much? 200,000. It has suffered an impairment loss of 200,000. So it means therefore that this asset appears in your books at a higher value more than the necessary. In your books it has a carrying amount of 1 million, but in principle it should have a carrying amount of, it should have a value of 800. So we need to reduce the value of this asset by 200,000 from 1 million to make it 800, which is the recoverable amount. How do you write off this 200? This 200 will be considered as a loss against the profit. So you will go to this asset account, whichever the asset, which we are saying it has a balance brought down of 1 million. Let me put the figures in thousands. Then you write off 200,000 against this asset. So you will debit profit and loss and you will credit the asset by 200,000. That's how we write off an impairment loss of this asset. So we have compared the carrying amount of the asset with its recoverable amount. I have said there is only one condition under which an asset is said to have suffered an impairment loss. Only when the carrying amount of that asset is higher than its recoverable amount. Then I've said, if the asset has suffered an impairment loss, then that impairment loss should be written off against the profit. That impairment loss should be written off against the profit in the profit and loss account. So I have debited P&L account and I've credited this asset. Good. Let me develop further. Suppose as a company, you have another asset. Let's call it asset A. This asset had a book value of 100 million in your books. Then during the year, you revalued this asset. As a company, you revalued this asset. Let us assume you revalued it by an extra 20 million upwards. So what did you do when you revalued the asset? You as a company, you must have debited the asset and you must have credited an account called revaluation reserve. By how much? By 20 million. You must have debited the asset, credited this account we are calling revaluation reserve by this 20 million. That is asset A. Now listen. So it means now your asset now has a carrying amount of 120 million. It had a book value of 100 million at the beginning of the year. Then you revalued it by an extra 20 million. So you debited the asset, you credited the revaluation reserve. So we are now saying from now onwards, this asset has a carrying amount of 120 million. But suppose by the end of the year you want to know whether it could have suffered an impairment loss. So what did you do? You calculated its recoverable amount. And let me assume that when you computed the recoverable amount, you got it as 90 million. So the question is, has this asset suffered? Again, remember it has a carrying amount of 120. Come the end of the year, I computed the recoverable amount and I got it as 90. So it is obvious this asset has suffered an impairment loss of 30 million. Now listen carefully. The question is, how do you write off that 30 million, which is the impairment loss? Do you write it off the same way we wrote off the 200? Do we write it off the same way we wrote off the 200? Remember, for the first asset, we saw the asset had suffered an impairment loss of 200,000. So I credited the asset, which is here. I credited the asset and I debited P&L account by 200. Now listen. When an asset which has been revalued, suffers an impairment loss, then the accounting standard says that impairment loss should be written off in a particular order. Meaning, not all of it are you going to debit in the P&L account. Listen, remember, this asset had been revalued. And in your books, you are saying it has a revaluation reserve of 20. Come the end of the year, it has suffered a loss of 30. You cannot say that the asset has a gain of 20 and at the same time it has suffered a loss of 30. What do? Listen, this 30 must be written off in a particular order. Listen, so first you consider it as a revaluation decrease, meaning write off the revaluation reserve. You cannot say the asset has a revaluation gain at the same time it has a loss. So what do you do first? Write off the loss, the revaluation gain. Write off. Against the 30, write off the 20. So this 20 we were classifying as a revaluation gain, I write it off first. Meaning, I will debit the revaluation reserve by 20 million. I will credit the asset by how much? By 20 million. It's true the asset reduced with the 30. But this 30 is what we are discussing. How do you write it off? I'm saying to write off the 30, we write it off in a specific order. First, we consider it as a revaluation decrease. In other words, write off the revaluation reserve that is for that particular asset. Write off the revaluation reserve which is for that asset. Once you write off the 20, there is a balance of 10. Remember, the loss was 30. You have written off 20. And therefore, you are remaining with the excess of 10. It is that 10 now that you write it off against the profit the way we wrote off the first one. So it is the 10 that you now charge in the profit and loss account. It is the 10 that you now charge to the profit and loss account. So I hope we are together there. I hope we are together there, where we are saying, you as a company, I'm reviewing there, you as a company, you had an asset which had a value of 100 million at the beginning. You revalued it by 20 million during the year. So effectively, it has a carrying amount of 120. Then I said, when you revalued the asset, you debited asset, you credited revaluation reserve. Then come the end of the year, you wanted to know whether your asset has suffered an impairment loss. So you compared the carrying amount, which is this 120, with the recoverable amount. And I'm assuming you have computed the recoverable amount and you got it as 90. So we have said this asset has suffered 30. This asset has suffered an impairment loss of 30. It is that 30 that I'm saying should be written off in a specific order. First, write off the revaluation reserve. First, write off the revaluation reserve for that asset. I have debited revaluation reserve to write it off. I have credited the asset. Then I've said any excess of the impairment loss, any excess of the impairment loss is what should be written off against the profit. So in our case here, the excess was 10. Is that 10 that I wrote off against the profit? Hope you are together so far up to there, because some questions come when an asset has been revalued. Some of your questions come with a case where the asset had no revaluation reserve. Are you there? I hope we are together up to there now. So that's how we test impairment of an asset, and that's how we write off the impairment. It could be a plain asset which has no revaluation gain, or it could be an asset which has a revaluation gain. Now we move on and ask ourselves, we have said, to know whether an asset has suffered an impairment loss or not, we have said you compare the carrying amount of that asset with its recoverable amount, with its recoverable amount. Then I've told you the carrying amount of the asset is the amount at which the asset appears in the books. The amount at which the asset appears in the books is the recurring amount. That means the book value. Then I told you we shall discuss how to compute this amount we are calling recoverable amount. So let me discuss how do we calculate the amount we are calling the recoverable amount of an asset. How do we calculate the recoverable amount of an asset? Now listen. Now, to calculate the recoverable amount of any asset, you have to calculate two values for that asset. One of the values you compute for that particular asset is amount we shall be calling the fair value less costs to sell. Less cost to sell. In other words, in simple, it is what we call the net realizable value. To get the recoverable amount of an asset, you calculate two values of that asset. One of them is what we can call the net realizable value. In simple, it is the fair value less cost to sell. Fair value is the same as market value. That's what we refer to as fair value of an asset, same as market value. You less cost to sell. Then you compute another value, which we call value in use. Value in use of that asset. So let me assume for our asset, which had a carrying amount of here 1 million, which had a carrying amount of 1 million here, you computed the net realizable value and you got it as, let's assume, value in use. Let me assume value in use. You got it as 800,000. For the net realizable value, let me assume you got it as 700,000. So I'm assuming you computed these two values, that asset. For the fair value less cost to sell, you got 700. For the value in use of the asset, you got 800. Now listen, whichever of those two is the higher, whichever of the two is higher, that is what you consider to be the recoverable amount. So in our case here, the higher of these two is 800,000. Is 800,000. That's how we determine the recoverable amount of an asset. So listen. So if you are told to define, what is recoverable amount, and you have been asked again and again as a theory question in your past papers, define the term recoverable amount. And we are saying recoverable amount of an asset is the amount that is considered to be the higher of, number one, net realizable value, number two, value in use. The higher of the net realizable value, or number two, the value in use. Whichever of the two is higher, that is what you consider to be the recoverable amount. But then the question now comes, how do you determine this amount we are calling the net realizable value? So to get the net realizable value of an asset, listen, get the net realizable value of the asset, you take the selling price of that asset, you minus cost to sell. You minus cost to sell. That's why we were saying fair value less cost to sell. I told you fair value is the same as market value. Fair value is the same as market value. So that means assuming the market price of that asset is 1 million. But for you to sell that asset, it will cost you maybe another 300,000. For example, let me assume this is a machine which you want to sell in a particular location. But that machine is not in that particular location where it has to be sold for 1 million. Maybe it's an location number C or number B. But for you to bring it to location number A where it has to be sold, or town A where it has to be sold, maybe it will cost you 300,000 for transport or insurance in transit and so on, whichever the cost. So for you to sell this machine in this place, I'm only giving an example, for you to sell this machine for 1 million in this particular location or town A, you will sell it for 1 million. But it's not in that town. It has to be brought or maybe imported. And in the process of importing it, it will cost you 300 for transport or insurance in transit, whatever it is. So that 300,000 becomes the cost to sell. So effectively, yes, you will sell the machine for 1 million, but it will have costed you 300. So your net realizable value becomes 700. That's how we determine the amount we are calling the net realizable value. That's how we determine the net realizable value. You take the selling price less cost to sell. Good. Now we go to the second amount, is value in use. Value in use. How do we get this amount we are calling value in use? Now listen. I want to assume that you as a company, you are testing for impairment of your asset. You are testing for impairment of your asset as at 31st December 2024. That's the time you are testing for impairment of your asset. You are testing for impairment as at this date, 31st December 2024. So what you will do to get the value in use, you will ask yourself as a company, this machine that we shall be using in the future, how much are the cash flows that will be generated? Which cash flows are these that will be generated from the continuous use of that asset? As we shall be using the asset in the year 2025, 2026, 2027, 2028, 2029, we try and project those future cash flows. Once you get those future cash flows that will be generated from the continuous use of that asset, then what you do, you get the present value of those assets, of those cash flows. You get the present values of those cash flows. You have done finance, so you know how to get the present value of future cash flows, because you multiply the cash flows by a discounting factor. How do you get that discounting factor? I hope you still remember. It is 1 plus r to the power of negative n. That's how you normally get the discounting factor when you want to get the present values, the future cash flows. So now listen. So to get the value in use of an asset, you as a company, you will be required to estimate, get the expected future cash flows. What are those expected future cash flows that will be generated from the continuous use of the asset? Once you get the expected future cash flows, you get the present values of those future cash flows. So we normally define this amount we call the value in use. If you are told to define, which you have been told to define again and again in your past papers. So what is value in use? Value in use of an asset is the present value of the estimated. Value in use is the present value of the estimated future cash flows that will be generated the continuous use of an asset. Once you get those future cash flows, get the present values, whatever you get as the present value of those future cash flows, that is what becomes the value in use. So I've explained to you how to determine this key important amount, recoverable amount. It is important that you know how to calculate it because it's the main thing in the topic of impairment. Normally the examiner sometimes give you the carrying amount. That's not a problem, but he will not give you the recoverable amount. Normally it's your responsibility to calculate the recoverable amount. I have started by defining what is a recoverable amount. And I've said a recoverable amount of an asset is the amount that is considered to be the higher of 1. Net realizable value, 2. Value in use. Then I've gone further and said, how do you get the net realizable value? Said, get the net realizable value. You take the selling price of the asset and you minus any cost to sell. Good. Then I've said, you compare that net realizable value with the value we are calling value in use. Value in use. I've told you how do we get the value in use. First, as a company, you will try to project the future cash flows that will be generated. The continuous use of the asset. Now, once you get those expected future cash flows, get their present values. So we have said, we define the value in use as the value, so as the present value of the estimated future cash flows of an asset that will be generated the continuous use of the asset. Now, listen to this now. We are discussing the topic of impairment of assets under this accounting standard called IAS number 36. Now, that same accounting standard, listen to this now, another key important point. This standard identifies for you as a company which cash flows are these that should be discounted. We are going to get the present values of the future cash flows, meaning you get the discounting factors, 1 plus r to the power of n, year 1, n year 2, n year 2, 3. You know how to do that. You have done finance. Of course, we shall do that when we are doing a question later, but you know how to compute the present values. But the point is this. This accounting standard identifies the 3 components of the cash flows that should be discounted. The accounting standard identifies 3 components of the cash flows that should be discounted in the determination of the value in use. it identifies three components of the cash flows. Number one, any cash inflows that will be generated from the continuous use of the asset. As we shall be using this asset, are there any cash inflows that will be generated? Yes, this and this and this and this, whatever the company will have identified. So that's one of the components of the cash flows that should be discounted. Number two, any cash outflow, listen, that is necessarily incurred in order to generate future cash flows. Let me explain. We are projecting the cash flows from this machine, and maybe somewhere you realize as a company, maybe somewhere in the fourth year, we shall have to spend some 1,000 or 300,000 or 20,000 for the maintenance of that machine, for maintenance or repairs. Remember, we shall spend that 20,000 or that 200,000, whichever the amount will be, in order to help us for this machine to generate more cash flows in the future. It will require some maintenance. So that's a cash flow that is necessarily incurred in order to generate future cash flows. So if your company projects that somewhere in the future, you as a company will have to incur some cash, and that cash you are spending is only to help you to generate more cash inflows from that asset in the future, then that is another component of the cash flow that should be discounted. So I've said, number two, any cash outflow that is necessarily incurred in order to help generate future cash flows. That's another component of the cash flows should be discounted. Number three, the third component of the cash flow that should be discounted in the determination of the value in use is this. You all know at the end of the useful life of the asset, that asset will have to be disposed. So there will be a disposal of an asset. In most cases, when you sell or dispose an asset, you are the one who receives cash from the sale of the asset. But also in some cases, whenever you dispose an asset, at the end of its useful life, as a company, you may not necessarily be the one receiving. You may be the one incurring some cost. Let us assume it's a machine. For you to dispose it, it must be dismantled. That means it must be dismantled. For you to dismantle the machine, it will cost you whatever it will cost you. So another component of the cash flow that should be discounted is any cash by the end of the year, any cash received or paid at the end of the useful life due to the disposal of the asset. At the end of its useful life due to the disposal of that asset. At the time of disposal, if you sell the asset and you receive cash, get that cash flow. If you are the one disposing the asset and incurring a cost, get that cash flow. It's a component of the cash flow that should be discounted when you are determining the value in use. So we shall do a question later on how to use these three components of the cash flows to determine the value in use. Otherwise, also normally sometimes asked, what are the components of the cash flows that should be discounted in the determination of the value in use? Say number one, any cash inflow that is generated from the continuous use of that asset. In the year 2025, what shall we generate from the use of the machine? 2026, 2027, 2028, 2029, 2030, and so on. So you try and project those future cash inflows. Number two, any cash outflow that is necessarily incurred in order to generate cash inflows in the future. This machine, I gave you an example, may require some maintenance in 2 to 3 years from now. So that amount you will spend for maintenance is what we are saying will become the cash outflow. But that amount is necessary that we incur it, because if we don't maintain the asset, it may not produce more cash inflows in the future. Good. Number 3, at the end of the useful life of the asset, that asset I've said will be disposed. Whenever an asset is disposed, in most cases, you sell the asset, you receive their cash. But once in a while, it may cost you some money. Maybe I've said to dismantle the asset, to dispose the asset, it may cost you a cost to dismantle the asset. Therefore, it may cost you. Good. Now, those are the 3 components of the cash flows that should be discounted. Now, another question. Listen to this now. I have said that as a company, you are required to determine the value in use. You project the future cash flows. You project the future estimated cash flows. The same accounting standard number 36, the International Accounting Standard number 6, gives company a guideline. It gives guidelines on how to project those future cash flows. How much shall be generated from 2025, 2026, 2027? How much will be generated? I've said the accounting standard gives some assumptions or some conditions on how you try to project the cash flows. Now listen. So to project the cash flow of year 1, year 2, year 3, year 4, year 5, year 6, year 7, year 8, and so on, listen. The accounting standard says that to project the cash flows for the first 5 years, the accounting standard says, or before we do that, let me start by another point. Number 1, let me start with another point first. To project these cash flows, I've said you don't have them, but you as a company, you must project them. Try and estimate the future cash flows. So this accounting standard says, in your projections, how you project, the projections must be based on reasonable and supportable assumptions. Your projections should be based on reasonable and supportable assumptions. That is one condition. That when you're trying to project the cash flow for the year 2025, 2026, 2027, your projections as a company should be reasonable and based on supportable assumption. Okay, that's one. Number 2, so the projections of the cash flow should be reasonable and should be supportable on assumptions, good assumptions. Reasonable and supportable should be based on reasonable and supportable assumption. Number 2, to project the cash flows for the first 5 years, the accounting standard requires you use the most recent budgets. That means to project the cash flow for the year 2025, I was assuming we are estimating the cash flows, I was assuming we are trying to test the impairment as at 31st December 2024. That's the year end. So I was saying we try and project the cash flow for the year 2025, 2026, 2027, 2028, and so on. I have said the accounting standard says to project those cash flows for the first 5 years, you use your most recent budget. For example, the budget of 2024 said we shall generate this amount, or we generated this amount of the cash flow from that machine this much. So from the past budgets, at least you can try and project from the past budgets, you can try and project the future cash flows. So I've said the accounting standard says that to estimate the cash flows of that machine for the first 5 years, then use the most recent budgets. So on the basis of your past budgets, you can try to project the cash flows for the first 5 years. Good. Then, now the question is, after 5 years, year 5, this is year 4, year 5, year 6, year 7, and so on, how do you project the cash flows of any period beyond the 5th year? Now, listen. To project the cash flow beyond the period of 5 years, the accounting standard says, listen, the accounting standard says that you project the cash flows of any other period from the 5th year through what we call extrapolating. You do extrapolating of the short-term cash flows. Of the short-term cash flows. Let me explain. Short-term cash flows. You extrapolate. For example, in the 5th year, we as a company, we projected we shall generate from the machine cash flow of 20 million. So in the 6th year, 6th year, how much shall we generate? 7th year, 8th year. We are saying to project the cash flow beyond the 5th year, you extrapolate those short-term cash flows using, listen to this now, using either a steady growth rate or a declining growth rate. For example, you as a company, you could assume that after the 5th year, we project our cash flows will be growing by 10% every year. 10% of 20 million is 2 million. So we project the cash flow for year 6 will be 22 million. Then you extrapolate that 22 on the 6th year using another steady growth rate, 10% again. 10% of 22 million is 2.2. So we project that the cash flow of the year 7 will be 24.2. Then you project the cash flow of the year 8 by the same 10%. That way you are using a steady, growth rate. Alternatively, listen, the accounting standard says you can choose to use a declining growth rate. In other words, you took your cash flow for year 5 to be 20 million. You project it will grow by 10% in the year 6, so it will come to 22. Then you project that in the year 7, it will grow by 9%. So 22 will grow by 9%. Then whatever it will become here, you project that again will grow by maybe 8%. So if your company uses such percentages which are declining, then we are saying the accounting standard says that to project the cash flow beyond the period covered by the most recent budget. Remember, for the first 5 years, I told you, you project using the most recent budgets. Then I've said, after that short-term period, which is 5 years, any other projection should be projected by extrapolating the short-term cash flows using a steady growth rate, or a declining growth rate, So our first one, which was 10% every year, it will grow by 10%. That was extrapolating using a steady growth rate. Alternatively, your company could choose that our cash flows will grow by a declining growth rate. But that's what the accounting standard says. Good. So I hope you now know how to project those future cash flows. I have said the accounting standard gives 3 conditions in trying to project the cash flows from the asset. 1, Those projections, I've said, should be based on reasonable and supportable assumption. They should be based on reasonable and supportable assumption. When you as a company are trying to project your future cash flows, let those projections be based on reasonable and supportable assumptions. The projections should be based on reasonable and supportable assumptions. Number 2, I've said the projections for the first 5 years, should be based on the most recent budgets. Okay? So the most recent budgets that you have as a company, they will guide you on how to project the cash flows for the first 5 years. Then I've said any projections beyond the period covered by the short-term cash flows should be projected by extrapolating the short-term cash flows using either a steady growth rate, or a declining growth rate. Good. Now, before we continue, let me give you a challenge. I want to see how much you know now from what we have already discussed. Let me give you a challenge or a question so that you answer me now. But before we do it, let me review what we have said so far. So that now when I am asking you a question, you will be knowing what we are saying. Okay? We have said, to know whether an asset has suffered an impairment loss or not. We have said, to know whether an asset has suffered an impairment loss or not, we have said you compare the carrying amount of the asset with its recoverable amount. Good. We have defined what's a carrying amount. We have said carrying amount of an asset is the amount at which an asset appears in the books. That in principle is the net book value. We have defined what is the recoverable amount. But before we go back and review that, I have already told you an asset is said to have suffered an impairment loss only under one condition. An asset is said to have suffered an impairment loss if the carrying amount of that asset, if the carrying amount of the asset is higher than its recoverable amount. So we were assuming if the carrying amount of your asset is 1 million and you have calculated the recoverable amount to be 800, you've got it to be 800, then we said, has that asset suffered? Answer is yes. Why? Because the carrying amount is more than the recoverable. Therefore, the asset has suffered an impairment loss of how much? 200. So we have said that 200 being the impairment loss, it should be written off against the profit and loss. How do you write it off? They said you credit the asset because it had a book value of 1 million, but the true value is not 1 million. True value is 800. So reduce that asset by 200. So you credit the asset and we have said you debit P&L. Good. Then I've gone further and said, what if one of your assets had been revalued? I gave an illustration here. I said, if your asset had a book value of 100 million and during the year you revalued it by another 20 million, okay, then it means from now onwards, your asset has a carrying amount of how much? 120 million. Then I said, suppose by the end of the year something happens and you want to know whether your asset could have suffered an impairment loss. So you computed the recoverable amount and you got the recoverable amount as 90. Then I asked you, has that asset suffered? And we said yes. By how much? By 30. Why? Because the carrying amount is still higher than the recoverable amount. So it has suffered 30. Then I told you, how do you write off that 30? I told you, you don't write it off the same way we wrote off the other 200. The other 200, the asset had not been revalued. But now, this asset has been revalued. And so I said, the accounting standard says that when an asset which has been revalued suffers an impairment loss, that impairment loss should be written off in a specific order. Our asset has suffered a loss of 30, but remember, you had already revalued it by 20. So in your books, you cannot say that this machine has a gain of 20, it has a revaluation gain of 20, at the same time it has suffered a loss of 30. No. We said, what do you do now? First, write off. First, write off any revaluation reserve that asset. In other words, the impairment loss should first be considered as a revaluation decrease, where I said you now debit the revaluation reserve, write off that loss, to write off that revaluation, and you credit the asset by 20. Then I said any excess of the impairment loss, that excess now should be the one to be written off against the profit. Like in our case now, our loss was an extra 10. The loss was 30. 20, we have written it off against the reserves. We are left with a balance of 10 as an impairment loss for this asset. That 10 is what you write off against the profit. Good. Then from there, we discussed how do you determine this amount we are calling recoverable amount. That was another key item I told you in an exam you should understand. How to calculate the recoverable amount of an asset. Because I told you, no question will give you the recoverable amount. In most questions, you are required to compute the recoverable. I told you this. To compute the recoverable amount of an asset, you calculate two values that asset. One is what we have said, fair value less cost to sell. In simple, that is the same amount we call the net realizable value. Told you, how do we get that net realizable value? We said you take the selling price of the asset, you minus any cost to sell. That's important. Some questions give you the selling price. They tell you somewhere down there that for you to sell this asset, it will cost 300,000 for transport, blah, 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 as the selling cost, whatever it is. So you don't use 1 million as the net realizable value. No, you have to calculate it. That's what we are saying. So assuming you got 700,000 as the net realizable value for the asset. Then I've said you compare that with another value we have called value in use. Then I told you whichever of the two values is higher between the net realizable value of the asset and the value in use of the asset, whichever of the two is higher, that's what I said you consider it to be the recoverable amount. So that's how we defined the amount we are calling recoverable amount. Told you, questions ask you to define it. I said recoverable amount of an asset is the amount that is considered to be the higher of 1, net realizable value, 2, value in use. I've already reminded you how to calculate the net realizable value. But how do we get the value in use? I've told you, get the value in use, you get the present value. Get the present value of all the estimated, in other words, of all the expected future cash flows. Okay? Get their present values. That will give you the value in use. Be the present value. Once you get the present values of the cash flows, that will give you the value in use. Then I've talked about which are these components of the cash flows that should be discounted. I don't have to repeat that. There are 3 components of the cash flows that should be discounted. Good. Now, from there I've talked about how to project the cash flows, blah, blah, blah. That's okay. But now answer me this question. Suppose a company has an asset here. This asset A has a net realizable value of 100 million. Its carrying amount is 90 million. While the value in use of the asset is 120 million. Let me put it 110. million. How much is the impairment loss of that asset? Somebody to chart. Somebody to chart and give me the impairment loss of that asset. How much has it suffered? Or in other words, has it suffered an impairment loss? What is the impairment loss of this asset? In other words, has it suffered or not suffered? If yes, how much? From the discussion we have done, I'm only testing you now. You chart and tell me whether this asset has suffered or not. If so, by how much? Chart and tell me whether you think this asset has suffered. If so, by how much? If not, you tell me no. Has it suffered? I'm waiting. Has it suffered? When you look at these amounts and the way we have discussed, I want you to tell me whether the asset has suffered or not. And if so, by how much? You chart. Look at those figures. Look at those figures. And tell me whether the asset has suffered. From what you have already said, has it suffered? Yes or no? If so, by how much? Yes. I'm waiting. I'm waiting. Has it suffered? Is somebody to suggest? Somebody to suggest? What have we said? The carrying amount should be higher than the recoverable amount. So I have already given you a hint. Yes. Yes. I'm waiting. I'm waiting to know whether it has suffered. Okay. Okay. Has it suffered? No. Let me explain. I've already told you to know whether an asset has suffered an impairment loss or not. You compare the carrying amount. Our carrying amount here is 90. Then I've said, compare that with an amount we are calling recoverable amount. And I've already told you, recoverable amount of an asset is the amount that is considered to be the higher of 1, net realizable value, and 2, value in use. Whichever of the two is higher, that is what becomes the recoverable amount. And according to this asset, the recoverable amount of this asset is 110. The higher of 1, net realizable value, 2, value in use. Whichever of the two is higher, that is what becomes the recoverable amount. So from here already I can see that the recoverable amount of the asset is 110. Our carrying amount is given, which was 90. Then once I get those two amounts, I have to look for the condition. We have already said, how do you know whether an asset has suffered an impairment loss or not? We have said, an asset is said to have suffered an impairment loss if the carrying amount of the asset, is higher than its recoverable amount. So it is obvious from here, this asset, the carrying amount is 90, while the recoverable amount is 110. So we can see now the carrying amount is less than the recoverable amount. So it is obvious this asset has not suffered any impairment loss. Hope you are following. This asset has not suffered any impairment loss. Why? Because the condition has not been met. Carrying amount of the asset is is less than the recoverable amount. Okay. Can I give you another one? Now tell me this one. You have another, let's call it asset B. It has a value in use of 140. Maybe it has net realizable value of 90. And the carrying amount is 150. Has it suffered? If yes, by how much? If no, you tell me no. I think now you're okay. You can try and calculate, see whether it has suffered. Has it suffered? Yes or no? Has it suffered? From the condition I've already given you, you chart. Okay. Yes. Thank you. Now we can proceed. Let's see by how much. We have already said the carrying amount is what? 150. To get the recoverable amount, I've said you compare two values. One, the value in use, and the net realizable value. I've said whichever of the two is higher, that becomes the recoverable amount, whichever of the two is higher. In this case, the higher of those two is 140. Then once I've identified that, I need to know whether the asset has suffered. To know whether the asset has suffered, said there is one condition. Only when the carrying amount of the asset is higher than its recoverable amount. Good. Is that condition met? Yes. I can see the carrying amount is higher. It's 150, while the recoverable amount is 140. So we can say this asset has suffered an impairment loss of how much? 10. You there? Good. So that's how you know whether an asset has suffered an impairment loss or not. Now listen. So sometimes the examiner will not give you the 140 as the recoverable amount. He will not give you, 140 as the net realizable value. He may not give you the 90 as the net realizable value. I told you, how do you get net realizable value? I told you to get the net realizable value, you take the selling price minus any cost to sell. Good. So you may be given the selling price of the machine, maybe it was 100 million. For you to sell that machine, it will cost you 10 million. You take 100 million minus 10 million, the cost to sell, you get it as 90 million. Good. But to get the value in use, you get the present values of the future cash flows. You get the present values of the future cash flows. Now listen. So some of your questions don't give you that net realizable value, but they give you and they tell you the following are the cash flows for the years 1, 2, 3, 4, 5, and 6. So they give you those cash flows. This one, whatever. I was saying, you know how to get the present values. What you will do, once you are given those cash flows, you will have to determine the discounting factor. Discounting factor. I told you, the examiner will give you the discount rate, and the formula we know, it's 1 plus R to the power of negative what? N. So from your table, or if you're not given a table, from your calculator, you can get the discounting factor. Let me assume the question tells you R is 10%. So it will be 1.1 to the power of negative 1. You get whatever it will be, 0 point something something. Okay? Then you come to the second one, 1.1 to the power of negative 2. It will be 0 point something something, whatever it will give you. Then that way, you get those discounting factors. Once you get the discounting factors, you now get the present values by multiplying this cash flow with its discounting factors. You get those discounting are the present values. Once you get the present values, you add all of them, and that will become the value in use. That's how we determine the value in use. Good. That's how we normally determine value in use. Good. That's how we shall be computing when the examiner gives you the future cash flows, Good. So today, I just wanted to introduce the topic. Today, I just wanted to introduce that topic. We shall proceed from there next time. We shall also write a few summary notes from what we have already said next time. We shall write a summary notes from what we have already said next time. But maybe before we go, let me explain one or two things. This is for those who are watching me through YouTube and also through Zoom. Tell your friends that we have online classes for advanced financial reporting like the one we are doing now. Tell your friends, or if you have not joined us, if you have not joined our online classes, you can join. We offer online classes for advanced financial reporting of the advanced level. Tell your friends, we also have financial reporting of the intermediate level. We are also offering financial management of the intermediate level. We are also offering financial accounting of the foundation level and the one of ATD1 and ATD2. In ATD1 and ATD2, they also have accounting. Those are the 4 subjects we are offering our online classes for. One is for advanced financial reporting, the advanced level. We're also offering financial reporting of the intermediate level, financial management of the foundation, of the intermediate, and financial accounting of the foundation level. Tell your friends that if they can't join the live classes, then they can buy what we call the pre-recorded videos. They can buy what we call the pre-recorded videos, whereby they can buy the pre-recorded videos for these subjects and watch the videos at their own free time, at their own pace, at their own free time, at their own pace. And whenever they have a question, they can call me anytime. Good. Then from there, if you want to reach me, you can reach me on this number 0722 65 8875. This is my number 0722 65 8875. Okay? You need the country code. It's 254. It will be 254 722 658875. That's my number. You want to reach me. 0722-658875. We also accept payments on installments. No problem. We also accept payments on installments. Now, those who are watching through YouTube, please subscribe to my YouTube channel. Please subscribe to my YouTube channel so that you can be notified whenever we post new videos into YouTube. Okay? Please subscribe by clicking that subscription button down there so that we can watch those, so that whenever we post new videos into the YouTube, you may be notified. Okay? I hope you have now learned something today. So if you have learned something, please click that like button. YouTube down there, click that like button. YouTube down there for this video. Say you like the video, like learning. You can even give a comment. We hope you have managed to understand something today. Learn something, click the like button. Maybe you can give a comment how you enjoyed the class. Good. Unless there's a question, for today I just wanted to introduce the topic. So next time we shall put down the summary notes of what we have learned today. Then from there I will develop the topic. Unless there's a question, somebody can chat. If you have any questions so far, and chat. Nothing, then I can say, please remind your friends that we have these online classes. One for advanced financial reporting of the advanced level, financial reporting of the intermediate, financial management of the foundation of the intermediate, financial accounting of the foundation level, and the accounting of the ATD1 and ATD2. I've said if you can't join the live class, then you can buy the pre-recorded videos where you get the videos for the whole syllabus and you watch them at your own free time. If you want to reach me, we have said the number is 0722-658875. Alternatively, need the country code, you use the 254 at the start. And for those of you who are watching me through YouTube, said you have not subscribed to my YouTube channel, please click that subscription button so that you can be notified whenever we post new videos into YouTube. I've also said click that like button. Hope you have enjoyed class for today. Please click that like button. Good. Also, you can give a comment how the class was. Good. Otherwise, see you next time. Bye for now. See you next time. Unless there's a question. Bye for now. Okay. See you then.